All right. Good morning, everybody. Welcome to the IPO Readiness Panel. My name's Jack Hogeboom. I'll be the moderator for today, which hopefully means this will be the most I'll speak all day. For those of you who know me, this is what I look like in a suit. Don't get used to it. This will probably be the last time anybody who knows me sees me in a suit. We have a great panel today. I think it's going to be a terrific discussion. I apologize for the late start, but I had a senior moment and thought it was at a different location, so blame. Right, I was down at the Monarch Beach. It was fantastic. In any event, let's do a couple of, we'll just do a fast intro and get right into it. Mike, why don't you go ahead and start down on your end, and we'll work our way down to Lou and then get started.
Sure. Mike Tomasulo. I'm with Baldwin Risk Partners. I head up their national management liability practice.
Andy Hall with NASDAQ. I work on the new listings team at NASDAQ. Started at NASDAQ in 2004 and have been on the new listings team since 2007.
Christopher Mora, Centri Business Consulting. I run our SEC and capital markets practice.
My name is Josh Harlow. I'm the CEO of Fathom Holdings. ROTH actually took us public, and Centri helped us get there, so great board here.
Marco Frajanel, I'm the president and CFO of Fathom Holdings, and I actually taken two companies public, so I'm probably the craziest person in this room.
And I'm Lou Ellis from ROTH Capital, Equity Capital Markets, been with the firm for 22 years, so looking forward to being on this panel.
You don't look a day over 18.
Yeah.
All right, so let's get started by talking about the state of the market. Lou, why don't you let everybody know what the current market dynamics are looking like and what you guys are seeing?
Sure. So market right now has been not very forgiving for new issuers. I think there was a mad rush last year to get people public. It kind of started early in the year, carried through the end of the year, and then kind of once November, December hit, a lot of it just came to a screeching halt. We saw valuations pull in. We saw more structured type IPOs. And then the other problem we'll probably touch on later on today is the Spac market as well. There's a whole separate panel for that, but that was a big piece of the market last year, was all the Spacs that were coming out to go public. So you have a lot of these Spacs that have a bunch of cash looking for targets. So that's another opportunity right now for those companies that aren't currently public.
Can you talk a little bit about the dynamic there and what factors are important for a company that's deciding whether to either do a Spac acquisition as a way to go public or do a straight IPO?
Yeah, I always lean toward the straight IPO. That's just kind of where I've worked at. So I'd always lean that way. I think the Spac market is tough. Valuations were coming in higher for those private companies, but we've seen since that pullback, I think to get financing alongside of it, a private placement alongside of a Spac, because we're seeing a higher amount of redemptions, is difficult. So I still favor the IPO market, but we do need this window to open back up. So hopefully some of the more geopolitical factors that are running right now are really kind of driving the lack of interest from investors.
Is there any kind of standard characteristic you could look at and say, okay, this company is ripe for IPO and versus not ripe? I mean, there was a period of time where having revenue was the kiss of death if you wanted to do an IPO. Being pre-revenue was where the action was. So how's the market dynamic these days in terms of what kind of profile company is ripe for an IPO?
We always kind of start with the jockey. We got two members here of the management team we really looked at here, and when you feel you can back that team to get them public, it starts there, because you got to be able to sell them, their background, and then their business too. So it really starts with the management team there, and then obviously the market opportunity that they're going after.
Andy, I know that there's been a lot of changes in the stock exchanges in terms of IPO pathways, and you and I had a quick conversation the other day about direct listings. Can you just talk briefly about that and give some insight as to how often that's a route that's traveled, and what kind of companies would be the ones who would pursue that kind of avenue?
Yeah, sure. Direct listings, it's a very kind of sexy word, very popular, gets a lot of press, but there are very few true direct listings every year. I mean, less than a handful. And why isn't it not an avenue is that a lot of private companies, they don't have the holders to meet the exchange requirements, which is, it doesn't seem like a lot, but it's 300 round lot unrestricted holders. So there's very few. In order to do a direct listing, you have to have an independent evaluation and meet the other normal listing standards. But when sometimes people say direct listing, sometimes they're already public on another exchange, and then this is their first listing in the U.S. That's not a true direct listing. So a lot of publicity, but not necessarily used as a vehicle as you would see with the normal IPO and the Spac listings. And just to kind of speak off of what Lou had talked about, so far this year for 2022, it's been very much a Spac micro-cap IPO market because of the geopolitical situation and the fear of rising inflation and higher interest rates. We've had 71 IPOs, 60 have gone to NASDAQ, but of the 71 IPOs, 48 were SPACs. And even if you look at the top 10 IPOs so far for this year, 9 are SPACs and only 1 is an operating company. It's a big one. It's TPG, the private equity firm that listed on NASDAQ with $1 billion raise. While last year was a completely off the charts year in terms of listings, 750 some odd IPOs to NASDAQ.
We'll leave the SPAC discussion for the SPAC panel, but I have to say I'm kind of surprised that there's still that many SPACs that are going public in 2022, given the hostility of the regulators and what's happened to some of the spectacular failures in the marketplace.
Yeah, I mean, it's still a good deal for those initial SPAC investors. You're getting paid to take a look. You get the common and the warrants. Even with the rise in interest rates, they just ratchet up what your return would be. To sit at an 7% return to hold your money for 2 years, maybe as long as 3 years, and then you kind of decide whether you want to be a part of that de-SPAC, that operating company going forward. And if you really like the sponsor, you think they're a smart group that has knowledge in the industry and is going to pick the right target, it might be a good long-term investment.
So Josh and Marco, I assume most people want to hear from you guys as somebody who's been through it relatively recently. I'm going to take things out of order a little bit. How did you guys decide the timing was right for you to decide to do an IPO?
Well, it really came down to growth. One of the things I learned a long time ago is that a good company is more likely to choke to death from too many opportunities than to starve from not enough. And that's kind of, I know it sounds strange, but kind of where we found ourselves in. We were actually having to almost slow our growth down because we couldn't afford growth. And so taking the company public allowed us to leverage our stock to be able to continue to afford growth and on top of that accelerate growth. It also gave the ability to start to acquire other smaller companies that we thought would be a great add-on to our business line. So we're real estate, but we also have mortgage, title, insurance, technology that we've been able to add on to ultimately allow us to generate more revenue per transaction. So going public allowed us to do that. One thing I'll say though is from a timing standpoint, we did it right when COVID started, right? We were going to go public, I think it was like April of 2020. That didn't exactly work out. Ended up being July because it kept getting pushed back. I know when I first started this process, someone told me that this is going to be one of the hardest things I ever did. And I served 8 years in the Marine Corps, infantry. I can assure you that that's not going to be the hardest thing. They weren't wrong. I mean, it's certainly one of the hardest things. So that's why it's so important to have such a really strong team, great CFO, great bankers to help you go public, great people like Centri. All of that is part of the team you need. So it's one thing to have timing, but also people and support to do it right, because otherwise it will be painful. It doesn't have to be.
Like I said, I've taken 2 companies public, and for many years I worked with some of the biggest investment bankers in the country. And when people tell me they want to take their company public, and I simply ask why, because I think what happens, a lot of companies they want to take their companies public for the sexiness of being a public company, and then are really verbalizing their goals. What are they trying to achieve in terms of taking the company public? Because you have positives and negatives to that. Staying as a private company, there are many positives and there's some negatives, and same thing with a public company. So the most important thing, understanding why you're doing that. What is it you're trying to accomplish by having a public company? And then really understanding the challenges with that. The old saying, you don't know what you don't know. Well, in this case, it applies. Because there are many things you don't know about the product. And this is from someone that took a company public in '98. The market has changed a great deal. And so there's so many things you don't know about being a public company that you really have to think about why you're doing that and making sure that you're really doing it for the right reasons, because there are many, many challenges associated. Look at the market in the rest of a few months, right? And so there's an enormous amount of time and energy that takes away from running the business to dealing with being a public company. And what I find is a lot of people underestimate the amount of time it takes to actually run a public company. And so you really have to think about what are your goals in trying to be a public company, and that's really the most important thing initially.
I think from a timing perspective, I think you have to be ready to time the market, right? So you can't just overnight say, hey, I'm going to become public in 3 to 6 months or things of that nature. I mean, you could try. It's going to take a lot of time, effort. You're going to have to write the right working group. It's going to cost you a lot of money, right? So there's no disadvantage for a company preparing and getting that muscle memory to get the financials in order, making sure that you're liaisoning with the bankers, getting the right legal team involved, understanding the listing requirements, having the right insurance, having all that mindset on the road to be able to pull the trigger allows you to kind of time the market and be ready for when things kind of turn around.
I don't know how many here are CFOs of, if you're a private company right now, but I'll tell you that once you become, even in the process of becoming a public company, and it takes more some time. Centri actually is the company that helped us through that process. Myself as CFO of the company, in the early days of the process and continue, 50% of my time now is just dealing being a public company. The challenges, the reporting. And so where I used to be focused on the business 100%, now 50% of my time is allocated just to the challenges and obligations of being a public company. So if you are a financial executive and CEO of the company, your time is going to be allocated in very different ways. And so you really have to recognize that. And having a partner, in our case with Centri, and they helped us tremendously through the process, is imperative to that. Because there are a lot of challenges, and you talk about muscle memory, but it's very true. Like we continue to do things, and your whole schedule changes on your quarterly reporting and in conferences and all of that. So for the senior executive team of the company, your availability of time in terms of focusing on the business to being focused on being a public company is enormous. And so you really have to recognize, all of those challenges and how much time it takes, and recognize, and sometimes having a partner, not sometimes, actually probably most of the time, having a partner will help a great deal to learn, how to avoid mistakes and how to do the right thing at the right time.
So you talked pretty well about the strategic decision to move forward. Operationally, how did you know whether you had the resources in place, and what did you find that you needed to put in place in order to make the strategic decision turn into a reality?
Well, I can assure you don't have everything in place. So the first thing is just to accept that no matter how good you think you are, you're not good enough. You do not have it. I mean, our accounting team went from 6 people to 20.
Wow.
Just dealing with the challenges of restructuring. You have to deal with new technology, accounting technology. You have to do how you report, understanding auditors. You have to, hire an auditing firm, and you have to do that. You have to have 2 years of auditing reports, and going back, which is, if you are a private company, it's probably one of the most frustrating things. And because, again, your mindset is very different. Now you have auditors who are going to go through your entire business, and they have to understand, and they have an obligation, right, to the stockholders to go all that. So no matter how ready you think you are, I can assure you're not ready. And believe me, this has come from somebody who had, when we did this, I said, look, I've done this one already, right? So, piece of cake. I couldn't be more wrong. Right? And so just having that acknowledgement that you're not ready, and then finding people who can help you through the process. And then one more thing I'll add is there's a financial cost to that, right? If you want to hire the right people to help you through the process, you have to, they are expensive in a sense. They're very valuable, and it will save you a great deal of money from making mistakes, but you have to have the right partners to help you so you can avoid mistakes, because again, you don't know what you don't know.
Josh, did you have a comment you wanted to make?
I was actually going to say, I'd add one thing to that is, if depending on where you are in the process, from the time we decided to take the company public to the time we actually went public was almost 2 years. Didn't have to be that way, but we started early in the process, figure out, okay, what's needed, what do you need to put in place, what's that going to cost, and make sure we did it the right way. So whether you do now or whether you do it later, start thinking about that right now. Even if you think 3 years from now, start putting things in place now. That way, when the auditors get involved, it makes their process a lot easier. and will save you a boatload of money, because I think the more they've got to spend digging through your stuff, the more it's going to cost you.
The right team's just so important. I think when it comes down to the auditors, the legal team, even again, listing, I just can't emphasize so much getting the working group together and having that open communication and everyone familiar. And a lot of us have done this before, right? I think on kind of the consulting side and the auditor side, we've worked with the various attorneys, the various auditors and things of that nature. So, generally having everyone really comfortable and preparing for that saves you time on the back end, right? So whether you're filing confidentially and the market's not ready for you or things of that nature, at least you've gotten everyone kind of accustomed together working with each other, so that again, when you want to pull the trigger and when timing looks right to flip that S1 public or to pivot maybe into a de-SPAC transaction or something along those lines, you have maximum flexibility with your company and make the right decision.
So Lou, a company like Fathom Holdings comes to you and they engage Roth to be the lead banker for their IPO process. What kind of conversations are you having with them? What kind of advice and guidance are you providing to them in terms of, do they have the right resources in place? Obviously, you must have some feel for what these companies need that they may not know they need. So what's your guidance to them?
Our guidance really is work with them on positioning for the most part. I mean, not just the presentation, which is a big important because that's their kind of coming out party with the investor, but also some of the items on the back end in dealing with how to handle dealing with the SEC, with your auditors, with your attorneys, how to kind of move those processes along. But that's early on the stage. I'm more on the capital market side, so I'm more on the execution and selling. So I'll leave that question for Bob.
Can I add something to that though? They did a lot more than that. I mean, he talked about positioning. I mean, our slide deck, I think we went through 60 iterations. 60 versions. And a big part of that is helping you become concise. How do you tell your story in less and less words to where, you tell the story faster, but also if you leave the deck with them, they still get it without having to hear the story from you. They played a big part in that. I can't tell you how much we appreciated that. But also pricing, right? Also which investors to talk to and how to have those conversations and what they should be looking for. They play a much bigger role than he led on. And so we leaned on them very, very heavily. We cannot tell you how much we appreciated it.
So Josh and Marco, any significant surprises along the way? Something that you would caution everybody to be on the lookout for? Things that just kind of came up and it was like, oh, wow, we just never thought we would need to focus on something like this.
I think the very first thing was D&O insurance. I thought the term throwing up in your mouth was just a term. I literally did that. There's a lot of little things along the way that were surprises. Nothing that we weren't prepared for because we had a great team in place. I mean, like you said, between attorneys and Centri and Roth and everyone else that gets involved, the auditors you work with, everyone's there to support you. It doesn't always feel that way. Sometimes it feels like the auditors are your enemy, but they're not. They're there to protect you against yourself sometimes, right? So they are your friends if you use them the right way. But a lot of it was just, I think, cost that we weren't expecting. I think it's cost several $1 million a year just to be a public company. So all of a sudden we think we're going to be profitable, 1 year sooner. Instead, no, we're going to be another year before we hit profitability because the cost associated with being a public company. That sucks, right? So things that you start to think about and start accounting for. Anything else you'd add?
I think that the importance of a team. I've always thought that was important, but I to a certain extent underestimated the importance of that. And a team that has really be cohesive, because there are so many issues that touch different things. In our IPO process, there was some difference of opinions about revenue recognition, and we have to talk to several people about that. And we took a very, 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 very conservative, which ultimately turned out to be the right one. But through the whole process of that, and so there's so many different topics that touch different things: the attorneys, the auditors, your partners, your consultants who are helping you through this process. So I think I underestimated a little bit about the amount of time and energy that it takes, to be 100% honest. And it does take a lot of time. And so that's probably one of the things that surprised me the most. And then you're ready to go, and then you got to meet certain deadlines too. And so if you pass a deadline or you're getting close to a deadline, the SEC wants different things, and just dealing with the government agency And so just that surprised me a little bit how long some things took. Now we went public during the pandemic year, just to make things a little more interesting, right? Because we didn't have enough fun just doing a normal year. We decided to do that in a pandemic year. So
It was a good thing. No one could leave the house effectively.
it was.
So you had maximized
I
team
kid
and-
around
and
because we
things of
went
that
from
nature.
right. We went from March, the pandemic hits, like okay, we never go public, to 3 months later going public. And so you can imagine how crazy that period of time it was for us. So we, you know, and we're already in a business that was growing very quickly and just dealing with all of that. So I just think don't really be careful not to underestimate the time and energy that it takes. Okay, it is not something for the faint of heart. Do not take this lightly. I know people get excited about being a public company, and it takes really a great team. You really have to, and it's not only a great team of great companies around you, but they all have to work together. And so typically when we talk to our attorneys, which I've been doing business with them for 20 years, they recommend the Centri because they had worked with Centri before. So talk to one of your key partners, and that partner will help identify others that they've worked with because they have to get along. They have to work together. And so if they don't, that creates even more issues, right? And ROTH was really a great partner. I had, when I took my first company public was with Mora and Bear Stearns. So it was, the days of .com and all that's a whole different ball game, right? And I, I hope there's nobody from Bear or Mora, but the experience we had with ROTH was excellent. It really was. I mean, they really helped us an enormous. So choosing the right investment banker is critical to your success. There's no question. Doesn't matter how good you think your business is your investment bankers can really help navigate those waters, and they can be challenging from time to time. So that, like I said, I think seems to be a theme. You choosing the right partners will get you there.
By the way, can I
Go
say
ahead, Josh.
two more things? So, one, Roth did not even ask us to say nice things about them. We're saying nice things because they deserved it. I want to talk about two things: trust and virtual. One, on the trust side, he talked about revenue recognition. You're going to get advice from people you think are the end all be all. But if your gut tells you otherwise, don't be afraid to challenge it and push back and go seek counsel outside if you have to as well. Because if we had followed the auditor's advice, it would have kind of screwed us over. So we actually had to go to the SEC for advice. So just great auditors, we love them. I think they're fantastic people, but sometimes this is true of all. If you feel like it's just not right in your gut, it's okay to challenge it. It's okay to say why, and you show me why, and you prove it to me. So that's one thing. So just take the time to ask questions, push back if you feel you need to push back. And the other is one of the benefits that came out of the pandemic, which not a whole lot benefit came out of, is the fact that we were able to do 90 investor meetings in 2 weeks. You can't do that in a normal environment. You're on an airplane going back and forth, right? I mean, we didn't get bathroom breaks. Shame on you guys. No lunch breaks, no bathroom breaks. Literally, 10 meetings per day for 2 weeks straight. But you can do that in a virtual environment. That was fantastic. That made it very easy. So when it came time to actually price our offering, we had way more money coming in. I think it was 20x oversubscribed. That could not have happened, I don't think, unless through that the virtual environment helped.
So obviously you make the strategic choice, you put the operational plan in place, and then it's time to execute. And there's a lot involved in the execution of that process. The lawyers love to go and fly spec everything, and they'll point out all the little I's that didn't get dotted and the T's that need to get crossed. And I see you sort of making a facetious gesture over there, Josh, but again, just like your auditors, we're trying to protect you from yourself. But there can be companies that play it a little fast and loose when it comes to things like board approvals or observing the corporate niceties, and you just can't afford not to be cleaner than Caesar's wife when you go through the IPO process. And I don't want to belabor that because this is not a lawyer's panel. This is more about the process. So, understand that your lawyers will have a role to play, and they'll be in your ear all the time being pains in the butt, but they're doing what you really need them to do for you to survive as a public company. But what I really wanted to focus on was to get Chris's insight, because one of the major aspects of this process is creating financial statements and a financial reporting system that's going to satisfy the SEC's requirements and put the company in a position for operational success. I mean, you don't have to be a genius to realize that the worst thing that could happen to you is to go out and do your IPO and not be able to timely file your first 10Q after you've gone public. So I know in the experiences that I've had directly with the Centri guys, it's been surprising how much effort and work goes into creating that process and how critical it is and what a major time component it is to the IPO process. So, Chris, I just think we ought to, give it the time and attention it deserves. And if you could talk about it a little bit, I think it would be helpful to the
Yeah,
audience.
I think when we approach a situation, it's really around kind of project management and understanding the regulatory requirements. And Jack, we're often doing that with the legal team as well too. Are we a foreign private issuer? Are we an EGC? Which box are we checking on the cover? That's really going to dictate what your requirements are. Are we doing 2 years of financials? Are we doing 3 years of financials? Really going through the financial reporting process, it's not about the initial filing or filing confidentially. Obviously, that's a milestone that you have to get to. It's about what happens when you hit staleness. Are you ready to do the Qs? Okay, can we, what does that look like? Are you ready to flip that filing public? Okay, and understanding what's coming through from the SEC comment letters and how you're responding to that. Do we need to pre-clear something? What does that timing look like? So a lot of this stuff is project management that we kind of look at it from the perspective of, what do we have to do today to make sure that you're successful to be there tomorrow, okay? And all of that muscle memory that we kind of talked about of pulling together your financial statements, whether it's year end or interim or anything along those lines, that's going to be what's successful for you to hit that Ks and Qs when you become the public company. And not only that, you have the Ks and Qs, you have the 8Ks, you have the follow-on offerings. What are all of those particular requirements? So if you have a particular misstep during that process, you could have different regulatory ramifications that happen, later on in the process and things of that nature.
You have some comments you want to make, Marco?
So having the right attorney is imperative. I talk to a lot of people that want to take their company public, and I'm always available to just share my experiences. I don't know everything, but let's just say I have enough scars that I can share what the process. But the attorney that we use, I've worked with him for 20 years, and he has taken probably 200 or 300 companies public. And so when he says you need to do this, I believe him. Like, we need to do this. So having that trust with your attorney is imperative, because he or she can really help you and guide you. When other people that you just begin to work, and again, we're very blessed to work in Centri and they were recommended by our attorney. So so by default, we trusted Centri right away because of that. So having one of your partners who is a trusted partner, in the sense that you have many years of experience in working with that person, is imperative, because you're going to question everything. Why do I have to do this? This doesn't make any sense. Why are we doing this? And so having that partner says, no, you need to do this because of this, and this. And I'm sorry, maybe it sounds like it doesn't make sense, but it is part of the process. It's really key. We worked with Ryan. Is Ryan in the room? No? I'm a little shout out to Ryan. He and I probably talked 10 times a day for 2 years. I think, and so, he was tremendous help in this process to do that. And again, having that trust, because you're going to have your attorney say, you need to do this and this and that. And some of it is going to sound like, why am I doing this? And so having somebody you trust is really imperative.
Yeah, the attorneys are really kind of the front line of defense, especially when dealing with the SEC. So maybe I'll throw the question back at you, Jack. What are you kind of seeing right now with the SEC in terms of review and process?
I think it's not dissimilar from what it's always been. It feels like over time it's gotten to the point where the SEC's gotten away from sort of the minor sort of ticky-tack comments that you used to see a comment letter with 130 comments from the SEC, and the comment letters are much shorter now, but they tend to raise some really interesting accounting issues almost all the time. And so, I'm not surprised that you had some back and forth on revenue recognition. That's the kind of thing that you would expect. And it's just interesting. It's part of the process, because maybe you hadn't thought things through as carefully as you now have to, because somebody's challenging the way you're doing things. And that's, to me, sort of the value of the IPO process, is that whole dialectic that gets created in that process. Explain to me this, what's your support for this statement in the prospectus, and you're basically teaching a group of people everything you know about your business and maybe learning something yourselves in the process.
Yeah, I'll share another benefit of having a great partner. You know, we worked with Centri for about a year prior to even starting the process with the SEC. And by the time we filed, we only got 7 comments back.
Wow.
And only 2 from your F pages, which is financial pages, which is remarkable. And that was because Ryan and his team and Centri helped us get organized, helped us put everything together. So by the time we got to the SEC, and it was funny because when we got our first, we're like, oh my God, we got 7 comments. We thought it was a lot of comments. And then we started talking to Roth, and they kind of paused and said, you only got 7 comments?
Right.
And so everything is,
Where's the other letter?
Yeah, where's the other letter?
yeah, where's the other one?
No, we only got 1 letter.
We rely a lot on the attorneys too during that SEC comment letter process, right? I mean, being accountants, I'm not a natural wordsmith. So how to particularly explain some of these complex issues in a concise way. There's a lot that goes back and forth with the attorneys and teams like Jack to make sure that we're responding in a concise manner and make sure that we're actually addressing the comment as well that's being set forth. Sometimes from an accounting perspective, we may think that we're addressing the specific comment, but working with the legal teams and just really understanding where the SEC is getting at and things of that nature. And there's also a lot of strategy in there too. Do we respond? Do we have a call with them? Should we, refile and respond? Should we respond and not refile? So there's a lot of cues that we take from the legal teams throughout that process to just understand the dynamics and the timing and making sure that we're getting down to the point of what needs to occur, because they have a great dialogue with the reviewers and dealing with them on a daily basis. So I kind of echo what Marco is saying is a lot of when you compile a working group and trust them, you really buy into what they're saying, and I think everyone has the issuer's best interest to get through, because we want the transaction to go through and to go to the next one. Right. But ultimately it's really understanding working with legal just to make sure that back and forth it goes really well.
I don't want to offend anybody by being trite, but in some ways, doing an IPO is like going pro as a company. You give up your amateur status and your ability to sort of do things the way you want outside of public scrutiny, and now you're under the glare of the spotlight. One of the things that the IPO process does is it makes people look at the membership on their board of directors. There are lots of requirements. Andy's, NASDAQ, and the other exchanges have requirements in terms of the independence of outside directors. The SEC makes you indicate why people are on your board, if there are any interested party transactions with those people. You have to have somebody that's a financial expert. And that person ends up having to be the chair of the audit committee, and you've got to have people on your audit committee that are financially sophisticated. If you have any contact in California, you have to have at least 1 woman. NASDAQ now has a whole diversity requirement that you at least have to respond to. Did you guys make a lot of adjustments or look at your board of directors in connection with going public?
No, we didn't. We thought very carefully about what that board looked like. We didn't have to, luckily, we didn't have to make any adjustments because of the diversity, because we did it right from the beginning. When you look for the right people, sometimes it just ends up falling in place that way. We got a great board, several women on the board, minorities on the board. Helps that he's a minority and an immigrant. But we had some great people. So we looked at, to your point, one person who's financial. I mean, he was a partner with a very large audit firm. We have someone who specializes in legal. We have someone else who specializes in marketing. We have someone else who specializes in, and it goes on and on. So we want to make sure that you don't just fill the board with people that are on the board, but each person brings some strategic value to the board. I think it's really key. You're going to be compensating for the board. Let's make it a win-win for both of you. So they've got to bring something to the board besides just, blowing smoke and doing whatever you want them to do. And by the way, you want them to push back on you. If they just sit there and do whatever you want, that's not necessarily a healthy board. It's okay for them to challenge you. You want them to challenge you because it keep them safe, keep you safe, and keep the company safe.
Audit chair is imperative. A great audit chair is probably the most important position in the board. Somebody who really, understands the whole audit process, understands all of that. I mean, it really is critical And we are very lucky to have a great audit chair who was a partner at a very large firm, and then he went to the private sector, took a company public, then came back again, and so it really is imperative to have a great audit chair. That person, he or she, can help tremendously in dealing with your auditors as well and some other legal issues. They have enough experience to know, which way to go, which way not to go. Again, we were very lucky to find the right person, but I've seen some companies that choose somebody and then it's not the right person. It's having somebody who's a very experienced audit chair is incredibly helpful.
I mean, there's just so much that happens to the board of directors when the company goes public. There are all kinds of, not to mention the potential for future liability, the need for timely disclosure, whistleblower processes have to be put in place. People have to understand the insider trading policy, et cetera, and that's sort of a good dovetail into Mike over there, who is here to sort of ruin everybody's parade. You need to have those processes and procedures in place because it's just too easy in this world for your board to get sued, and so you need to have the proper protections in place. So Mike, with that said, everybody understands that they need to have D&O insurance in place when the company goes public, and that market continues to be a challenging and expensive market. Can you talk a little bit about things from your perspective?
Sure, happy to. Well, you already heard what the feeling is on D&O insurance, right? I think throwing it in your mouth, yeah. Our Pepto sponsorship has gone really well for us, so that's been good. Yeah, I mean, the D&O market is it's just insane as far as the pricing. It doesn't make sense, actually. I think you probably felt that way yourself when you went through it. And so there are steps you need to take to try to mitigate it. I mean, you're not going to avoid it. It's a necessary evil. It's probably the one item that you're going to look at where it's going to deliver the most sticker shock. You expect to pay a little bit more for accounting, legal, but most private companies that are going public, no matter what they're hearing, don't expect it to be as expensive as it is. And it's something your board's going to want, right? They're going to demand it. They're not going to want to sit on your company without it. So there's been a lot of talk here about finding the right team, finding the right experts, and that holds true with the insurance as well. I mean, with the amount of money you're going to spend on that coverage, you really do need to align yourself with folks that understand the product, are doing it, are placing public companies, know the carriers, know the benchmarking, know the limits analysis, can really help you understand what the right coverage is for you. I had some slides, but I don't think they made it up, so I'll just talk to them. The questions are, how expensive is this really going to get, and how do I know what to buy, right? So to give you a sense of how expensive it's gotten, a company, let's say a $500 million, $2 billion, valuation IPO, a common policy right now, you buy about $10 million coverage for the board and the company, ABC coverage, and you'll probably buy another $10 million ASI coverage. That's just for the board. So
Check,
$20 million
check, 1, 2.
$10 million dedicated to just the individual directors and officers. That program could easily cost you about $2.6 million annually. And that's not even contemplating the fact that you're going to have between a $7.5 and a $10 million deductible. So just think about that for a minute. You're buying $20 million of coverage, but you're self-insuring the first $7.5 to $10 anyway, and you're paying, and you have the benefit of paying $2.5 to $3 million for it. So those are the numbers. I had talked to Jack. I thought we were going to change the heading of this panel to "Scared Straight." where we're going to go to. So what do you do? How do you mitigate that? And it's hard to avoid paying it, but there are things you need to do, right? Aligning yourself with an expert, making sure you're getting in front of the carriers. I would assume you did this as well. Setting up a call, having whoever your broker is, set up a call with 20, 30, 40 insurance carriers and telling your story, right? It's important for you to kind of be the face of the company, answer questions directly, and try to mitigate the risk and the cost involved. I will say, as a side note, and I know the Spac panel is coming up, but a Spac IPO will pay more than a traditional IPO as well. There's just a feeling amongst carriers that there's a lot more companies going public via de-SPAC that are not ready, and therefore that the risk is higher. So keep that in mind as well. Those numbers I gave you, that's for a traditional IPO. It's probably 20% higher for a de-SPAC IPO.
Wow.
So what you need to do then is you need to make sure you're aligning yourself with the right amount of coverage, right? And we just did a survey with our friends at NASDAQ. We collaborated on a benchmark survey for D&O, for public companies for D&O limits that went out last week. And that same $500 million to $1 billion market cap company, on average, is buying about $40 to $42 million of coverage. Why? I don't know. I don't know why they come up with that number, but it's too much. They're buying too much coverage. Most companies are buying way too much coverage because they're just being led that way by someone who doesn't understand the market, or they're just being led by their board. Now, what we like to do is we really hone in on the actual securities litigation. What's the claim going to be? Because I have $40 million, but if I get sued, what does that look like? So let's take that same company, and they have a 50% market cap loss. The median settlement for those companies, and again, 50% are going to be dismissed anyway, so that's a little bit of silver lining. But 50% of those companies are going to, that do settle, are going to settle at $5.5 million or less. And the average settlement is about $7 million. Okay, we add some defense costs, some other SEC fees if there's an investigation and whatnot. Let's call $10 million on average. They're buying $42 million in coverage. And they're self-insuring the first 7 or 10. So, you know, a lot of these companies are looking at this, and it's important to really educate your board and understand what the claims look like, what the landscape is, so that you can, you know, that's the way to save costs, right? Buy $20 million less in coverage than everyone else because you don't need it. Is it really, in this market, a way to save a lot of dollars?
So being a smart consumer then.
Yeah, just understanding it, taking a little time. It cannot be one of the last things you get to.
Do you get a lot of pushback from the board in terms of what the coverage limits ought to be? Is there that dynamic?
You know, it's a great question. And if you have the right data, Jack, if you can really show them, if I can put up a spreadsheet and I can show them 300 cases and 150 settlements and show them that the average settlement is $7 million, well, it's going to talk them off the ledge of needing $20, $30 million because, you know, the individuals on the board are very smart individuals, and it's hard to refute hard numbers, right? It's hard to refute just logic. Especially when the costs we're talking about.
I don't know. Logic takes a back seat when people are holding on to their own wallets. You know, that's the problem. Andy, the goal of all of this is to wind up with a company that stock is listed and traded on a public market, and that's obviously, for most people, the goal is to be listed on your exchanges. Can you give people a sense as to what your process is like? And I mean, everybody probably can figure out what the qualitative and quantitative standards are, but I'm talking about practicalities in terms of, you know, when should they be consulting with you? How do they work with you? What's the ideal pathway to managing that process in terms of a company's relationship with NASDAQ?
Yeah, sure. I mean, right now we're obviously experiencing some headwinds with the geopolitical situation, but 2021 was an incredible year. 752 IPOs to NASDAQ, 274 to the NYSE, 180 billion was raised on NASDAQ in 2021, 108 billion for the NYSE. The Amex had a handful of IPOs. But you know, we talked to the companies early in the process. I mean, what is the right offering size? Our quantitative requirements for listing are not that rigid. I mean, you could do a $15 million raise and get listed. But would you do it for the cost, for the loss of independence, for the D&O? Probably not, but you could be that small and just meet our listing requirements. When you engage with NASDAQ is when you really think about heading down this road, when you start to engage with the attorneys and talk more to the auditors and start talking to bankers. Even before talking to bankers, or you're talking to a number of them but haven't decided on one, you can start to interact with NASDAQ. You put your application in, you're listed upon effectiveness of the S1, so we move in tandem with them. There is the quantitative, but there's the qualitative requirements. That's more of the process where we do background checks on the officers, directors, and principal shareholders. Jack alluded to it from the committee standpoint. We require a majority of independents on the board, a fully independent audit committee of 3 members. As we indicated, that chair is a crucial role, and an independent comp and nominating committee. We do have a phase-in requirement item for IPOs. You need to have 1 independent director at the time of listing, but then you can phase in the majority of your independent directors in 90 days and then fill out the entire committee a year after listing. In terms of the diversity requirements that we put out there, they're a recommendation. It's not a mandate. If you have 6 people more on your board, we ask that you have 1 female and 1 minority, but it is not a mandate. It's not something that's going to prevent you from being listed initially or on a continued listing basis if you don't have it. We just ask that you disclose the diversity of your board. But in terms of the listing, there's the IPO ceremony in terms of the ringing the bell. As you compare with our competitor, does anyone know or care if you're listed on NASDAQ or the NYSE? Largely not. We're a service provider just like the attorneys and the auditors. From a fee standpoint, that's probably the big differential. For Fathom, their initial listing fee was $75,000. If they'd listed on the NYSE primary, their initial listing fee is $295,000. So 75 versus 295,000 on an annual basis. Marco's paying 58,000 annual listing fee to NASDAQ. It would be higher on the NYSE, and we also don't charge for listing of additional shares. So if you do want to issue out additional shares to acquire or to raise additional capital through a shelf offering, there's no incremental charge for that. I don't know, did I cover everything?
Yeah, I think so.
Okay.
So I'm just curious, in terms of the phase-in, how many companies actually, can you characterize by percentage what percentage are fully compliant when they initially list versus how many people take advantage of the phase-in?
I would say the majority, like Fathom, had the board in place. It's more kind of the private equity deals where that private equity person is on the board and expects to get off that someone uses the phase-in element. But you get 90 days after, kind of to finalize that, and then a full year before you have to meet the entire requirement. And then if a board member should step off, we give till the next annual meeting as a listed company, the next annual meeting or a year to fill out that vacancy for the independent director.
I would like to add one thing to that. I would like to highly recommend you do that. You get the board ready to go before you go public. A couple reasons. One, there's a lot of advice that can come from that, a lot of sage wisdom. You're always seeking wisdom where you can find it, but also it gives you more credibility with the investors who are looking at you. They're going to feel better about you when you're going through the IPO process, that you have a full board in place. So if you want that full evaluation, get your act together, get the board in place, and just give them the confidence they're looking for.
That's a great point. We could go all day. I mean, there's a lot of insight here, and there's so many different aspects to this that are interesting, and it's great having people up here that not only have been through the process but have worked together going through it. But I really want to leave some time. I mean, you've got some real expertise up here. So if folks out there have any questions they'd like to ask, we'd like to open it up now and see if there's something we can do to help you out while we're still up here. Anybody? Yes, sir. Go ahead.
So you talked about the presentation, roadshow presentation. So every time you change it, you have to change the S1. You go back. How many times does that process go on?
We did all that before that, right? So we created our first initial deck. It went to them. Actually, we had ROTH kind of review it first. We went through all of that, got it really concise, and then sent it to the attorneys. I mean, there's no reason to keep paying attorney bills if you don't have to, right? So ROTH played a great role and helped us refine that. Then once we felt like it was ready, then it goes to the attorneys and the auditors and the rest who can refine it, like, because they're going to change anything like great or awesome, gone. Anything that sounds exciting, it gets removed, so it becomes pretty boring and bland. That's their job, is to make it boring.
But you kept the forward-looking statements in there?
A few, yes, but we identified what is forward-looking statement. That's right.
Hopefully no market projections.
Yeah, but once all that's done, then yes, we make those changes in the S1 and we get it all.
It's one of the interesting challenges. You're running a private company, and we're all excited about our businesses, and then you're going to go public, and you have to change your mindset how you present your company, and it's an interesting change in mindset because it can be somewhat frustrating because you believe like you have a great company, but you have to be very careful how you sell that, right? And the potential for misrepresentation. And so it's one of the biggest challenges, that mindset that you have to adjust on, when you're going public, how you market your company, how you describe your company. And it doesn't matter how excited you are about your business, which you all are excited about our businesses, being public, it is a mindset. It's a change in mindset.
I'll give you one example. Get rid of the word will. It should be could or should. Will does not exist anymore. So just stop saying it now
Well,
so you don't mess up later on.
In all fairness, I think one of the biggest challenges that I have is trying to help companies distinguish between what they use for their internal management and motivational purposes and what they show the public. So, you know, I've seen more than one time a company serves me up a business description that lays bare their entire operating strategy, and that's what they use to manage their business. That's what all their senior managers know. But that's not appropriate prospectus disclosure, and you don't want to be showing your hand to your competitors. So knowing what the level of disclosure is and what's appropriate for that marketplace is really important. The other argument that I have, the other discussion, the educational process I go through with my clients to teach them how to protect themselves is it's always better to look backwards than it is to project forward. So market definition, addressable market sizes, things like that. It's always much safer and more appropriate to look at third-party sources, you know, market studies, research reports that say, you know, so-and-so projects that this market is going to be X by this date, rather than somebody saying, okay, we think we can penetrate 25% of this market, and here's what we think our selling price is going to be, and therefore, if you do the multiplication, this is what we think our addressable market is. And having that conversation with the CEO or the CFO about why they can't say that can be somewhat difficult and frustrating at times because they believe it, but it's not reasonable in a legal sense because there's no basis for concluding either A, that you're going to actually be able to sell at that price, or B, that your penetration is going to be at the level that you think it's going to be.
I want to add one more piece of hopefully sage advice. That is, stop talking. So right before you get ready for the IPO, you want to be promoting your business like you always have been doing for the last several years. You've been promoting your business. But if you do the wrong thing, you promote your business the wrong way right before the IPO, the SEC could require a cooling off period. And all of a sudden it could delay you going public. So just calm down the marketing a little bit, you know, kind of go into a quiet period. You'll have your chance to market the business. And I know you're excited, but you don't want to be stuck in that quiet, you know, or that cooling off period. That sucks.
Well, unfortunately, I see we're running out of time. I'll be happy to stand around outside for a little while if people want to come up and ask questions. Hopefully some of the other panelists will as well. Again, I apologize for the late start. It's totally my fault. I thank everybody. Thank you guys for being so patient with us, and thank you guys for sharing your wisdom.
Thanks, Jeff.